Hello friends. So today we will complete the remaining classes of popular chart indicators session. In this video we will cover below topics. How to use Williams %R, Williams % range. How to use ADX, average directional index. Ichimoku Kinkohyo. Trading with multiple chart indicators. What is the best technical indicator in Forex? Summary, popular chart indicators. So let's start with first topic. How to use Williams %R, Williams % range. The Williams % range, also called Williams %R, is a momentum indicator that shows you where the last closing price is relative to the highest and lowest prices of a given time period. As an oscillator, Williams %R tells you when a currency pair might be overbought or oversold. Think of it as a less popular and more sensitive version of stochastic. As a momentum indicator, it also gives RSI-like vibes in that it measures the strength of a current trend. But while RSI uses its midpoint figure, 50, to determine trend strength, traders use %R's extreme levels, -20 and -80, for cues. Let's discuss how to trade Forex using the Williams %R indicator. Did you know that stochastic and %R use the same formula to pinpoint the relative location of a currency pair? The only difference is that stochastic shows you a relative location by using the lowest price in a time range while %R uses highest price to pinpoint the closing price's position. In fact, if you invert the %R line, it will have the exact same line as stochastic's %K line. This is why Williams %R uses the 0 to 100 scale while stochastic is scaled from 0 to 100. A reading above -20 is overbought. A reading below -80 is oversold. An overbought or oversold reading does not guarantee that the price will reverse. All overbought means the price is near the highs of its recent range. The same goes for oversold. All oversold means the price is near the lows of its recent range. Let's look into determining trend strength using %R. Williams %R's sensitivity to volatile prices comes in handy when you want to know if prices are maintaining their bullish or bearish momentum. In Euro-USD's daily chart below, you can see that the pair tried to extend its uptrend but failed to reach a new price and %R highs. This means that prices aren't hitting the high end of their range as quickly as it did before and that the bullish momentum might be running out of steam. In this case, the pair ended up dropping 200 pips in a week. Have a look into the below figure. Almost immediately after that, the price gained enough bullish momentum to push %R above its oversold levels. But although Euro-USD is still popping up red candlesticks, they're not enough to drag Williams %R back to its previous lows. Another loss of momentum? Williams %R sure thought so. Turned out, the bulls did take over and pushed Euro-USD around 775 pips higher in less than 30 days. Now that's good oscillating right there. No wonder superfans call Williams %R as the ultimate oscillator. Let's move into another topic, which is how to use ADX, average directional index. The average directional index, or ADX for short, is another example of an oscillator. ADX fluctuates from 0 to 100, with readings below 20 indicating a weak trend and readings above 50 signaling a strong trend. When the ADX is low, it highlights periods when price is usually going sideways or trading in a range. When the ADX has risen above 50, this indicates that the price has picked up momentum in one direction. Unlike stochastic, ADX does not determine whether the trend is bullish or bearish. Rather, it merely measures the strength of the current trend. Because of that, ADX is typically used to identify whether the market is ranging or starting a new trend. ADX is considered a non-directional indicator. It is based off comparing the highs and lows of bars and does not use the close of the bar. The stronger the trend, the larger the reading regardless of whether it is an uptrend or downtrend. Take a look at these neat charts we've pulled up. In this first example, ADX lingered below 20 from late September until early December. As you can see from the chart, Euro to Swiss franc was stuck inside a range during that time. Beginning in January though, ADX started to climb above 50, signaling that a strong trend could be waiting in the wings. And would you look at that, Euro CHF broke below the bottom of the range and went on a strong downtrend. Ooh, that'd be around 400 pips in the bag. Book it, baby. Now, let's look at this next example. Just like in our first example, ADX hovered below 20 for quite a while. At that time, Euro to Swiss franc was also ranging. Soon enough, ADX rose above 50 and euro to Swiss franc broke above the top of its range. Tada! A strong uptrend took place. That'd be 300 pips, signed, sealed, and delivered. Looks simple enough, right? If there's one problem with using ADX, it's that it doesn't exactly tell you whether it's a buy or a sell. What it does tell you is whether it'd be okay to jump in an ongoing trend or not. Once ADX starts dropping below 50 again, it could mean that the uptrend or downtrend is starting to weaken and that it might be a good time to lock in profits. Let me tell you now how to trade using ADX. One way to trade using ADX is to wait for breakouts first before deciding to go long or short. ADX can be used as confirmation whether the pair could possibly continue in its current trend or not. Another way is to combine ADX with another indicator, particularly one that identifies whether the pair is headed downwards or upwards. ADX can also be used to determine when one should close a trade early. For instance, when ADX starts to slide below 50, it indicates that the current trend is losing steam. From then, the pair could possibly move sideways, so you might want to lock in those pips before that happens. So it's time to move forward with another topic: Ichimoku Kinko Hyo. Yes, you're still in the right place. You're still in the school of pipsology and not in some Japanese pop fangirl site, although Huck may disagree with the rest of the FX men on that. No, Ichimoku Kinko Hyo ain't Japanese for may the pips be with you. But it can help you grab those pips nonetheless. Ichimoku Kinko Hyo, IKH, is an indicator that gauges future price momentum and determines future areas of support and resistance. Now that's 3 in 1 for you all. Also know that this indicator is mainly used on JPY pairs. To add to your Japanese vocab, the word Ichimoku translates to a glance, Kinko means equilibrium, while Hyo is Japanese for chart. Putting that all together, the phrase Ichimoku Kinko Hyo stands for a glance at a chart in equilibrium. Huh, what does all that mean? A chart might make things easier to explain. Whoops. That didn't help. A few more lines and this'll resemble a seismograph. Before you go off and call this gibberish, let's try to find out what each of the lines is for. Kijun Sen, blue line, also called standard line or baseline. This is calculated by averaging the highest high and the lowest low for the past 26 periods. Tenkan Sen, red line. This is also known as the turning line and is derived by averaging the highest high and the lowest low for the past 9 periods. Chiku Span, green line. This is called the lagging line. It is today's closing price plotted 26 periods behind. Senko Span, orange lines. The first Senko line is calculated by averaging the Tenkan Sen and the Kijun Sen and plotted 26 periods ahead. The second Senko line is determined by averaging the highest high and the lowest low for the past 52 periods and plotted 26 periods ahead. Got it? Well, it's not really necessary for you to memorize how each of the lines is computed. What's more important is for you to know how to interpret these fancy lines. Let's discuss how to trade using Ichimoku Kinko Hyo. Senko. Let's take a look at the Senko span first. If the price is above the Senko span, the top line serves as the first support level while the bottom line serves as the second support level. If the price is below the Senko span, the bottom line forms the first resistance level while the top line is the second resistance level. Got it? Kijun Sen. Meanwhile, the Kijun Sen acts as an indicator of future price movement. If the price is higher than the blue line, it could continue to climb higher. If the price is below the blue line, it could keep dropping. Tenkan Sen. The Tenkan Sen is an indicator of the market trend. If the red line is moving up or down, it indicates that the market is trending. If it moves horizontally, it signals that the market is ranging. Chiku Span. Lastly, if the Chiku Span or the green line crosses the price in the bottom-up direction, that's a buy signal. It sure looks complicated at first, but this baby's got support and resistance levels, crossovers, oscillators, and trend indicators all in one go. Amazing, right? Okie dokie, we've already covered a smorgasbord of indicators. Let's see how we can put all of what you just learned together. It's time to discuss another topic. Trading with multiple chart indicators. Now that you know how some of the most common chart indicators work, you're ready to get down and dirty with some examples. Better yet, let's combine some of these indicators and see how their trade signals pan out. In a perfect world, we could take just one of these indicators and trade strictly by what that indicator told us. The problem is that we don't live in a perfect world, and each of these indicators has imperfections. That is why many traders combine different indicators together so that they can screen each other. They might have 3 different indicators and they won't trade unless all 3 indicators give them the same signal. Bollinger Bands plus Stochastic. In this first example, we've got the Bollinger Bands and the Stochastic on Euro to US dollars 4-hour chart. Since the market seems to be ranging or moving sideways, we'd better watch out for the Bollinger Bands. Check out that those sell signals from the Bollinger Bands and the Stochastic. Euro to US dollar climbed until the top of the band, which usually acts as a resistance level. At the same time, the Stochastic reached the overbought area, suggesting that the price could drop down soon. And what happened next? Euro to US dollar fell by around 300 pips and you would have made a hefty profit if you took that short trade. Later on, the price made contact with the bottom of the band, which usually serves as a support level. This means that the pair could bounce up from there. With the Stochastic in the oversold area, it means we should go long. If you took that trade, you would have gotten around 400 pips. Not bad. RSI plus MACD. Here's another example, with the RSI and the MACD this time. When the RSI reached the overbought area and gave a sell signal, the MACD soon followed with a downward crossover, which is also a sell signal. And, as you can see, the price did move downhill from there. Hooray for multiple indicators. Later on, the RSI dipped to the oversold region and gave a buy signal. A few hours after, the MACD made an upward crossover, which is also a buy signal. From there, the price made a steady climb. More pips for us, yippee. You probably noticed in this example that the RSI gives signals ahead of the MACD. Because of the various properties and magic formulas for the technical indicators, some really do give early signals while others are a bit delayed. You'll learn more about this in 6th grade. As you continue your journey as a trader, you will discover which indicators work best for you. We can tell you that we like using MACD, the Stochastic, and RSI, but you might have a different preference. Every trader out there has tried to find the magic combination of indicators that will give them the right signals all the time, but the truth is that there is no such thing. We urge you to study each indicator on its own until you know the tendencies of how it behaves relative to price movement, and then come up with your own combination that you understand and that fits your trading style. Later on, we will show you an example of a system that combines different indicators to give you an idea of how they can complement each other. Let's discuss another topic. What is the best technical indicator in Forex? Now onto the good stuff. Just how profitable is each technical indicator on its own? After all, Forex traders don't include these technical indicators just to make their charts look nicer. Traders are in the business of making money. If these indicators generate signals that don't translate into a profitable bottom line over time, then they're simply not the way to go for your needs. In order to give y'all a comparison of the effectiveness of each technical indicator, we've decided to backtest each of the indicators on their own for the past 5 years. Backtesting involves retroactively testing the parameters of the indicators against historical price action. You'll learn more about this in your future studies. For now, just take a look at the parameters we used for our backtest. Using these parameters, we tested each of the technical indicators on its own on the daily time frame of Euro-USD over the past 5 years. We are trading one lot, that's 100,000 units, at a time with no set stop losses or take profit points. We simply cover and switch position once a new signal appears. This means if we initially had a long position when the indicator told us to sell, we would cover and establish a new short position. Also, we were assuming we were well capitalized, as suggested in our leverage lesson, and started with an example balance of $100,000. Aside from the actual profit and loss of each strategy, we included total pips gained/lost and the max drawdown. Again, let us just remind you that we do not suggest trading Forex without any stop losses. This is just for illustrative purposes only. Moving on, here are the results of our backtest. The data showed that over the past 5 years, the indicator that performed the best on its own was the Ichimoku Kinko Hyo indicator. It generated a total profit of $30,341, or 30.35%. Over 5 years, that gives us an average of just over 6% per year. Surprisingly, The rest of the technical indicators were a lot less profitable, with the stochastic indicator showing a return of negative 20.72%. Furthermore, all of the indicators led to substantial drawdowns of between 20% to 30%. However, this does not mean that the Ichimoku Kinko indicator is the best or that technical indicators as a whole are useless. Rather, this just goes to show that they aren't that useful on their own. Think of all those martial arts movies you watched growing up. Aside from The Rock and the People's Elbow, no one relied on just one move to beat all the bad guys. The Rock used a combination of moves to get the job done. Forex trading is similar. It is an art, and as traders, we need to learn how to use and combine the tools at hand in order to come up with a system that works for us. This brings us to our next lesson, putting all these indicators together. So now let's come to the summary of popular chart indicators. Everything you learn about trading is like a tool that is being added to your Forex trader's toolbox. Your tools will give you a better chance of making good trading decisions when you use the right tool at the right time. In the below figure you can see common chart indicators. First indicator is Bollinger Bands. Bollinger Bands are used to measure the market's volatility. They act like mini support and resistance levels. Bollinger Bounds. A strategy that relies on the notion that price tends to always return to the middle of the Bollinger Bands. You buy when the price hits the lower Bollinger Band. You sell when the price hits the upper Bollinger Band. Best used in ranging markets. Bollinger Squeeze. A strategy that is used to catch breakouts early. When the Bollinger Bands squeeze, it means that the market is very quiet, and a breakout is imminent. Once a breakout occurs, we enter a trade on whatever side the price makes its breakout. Second indicator is MACD. MACD is used to catch trends early and can also help us spot trend reversals. It consists of two moving averages, one fast, one slow, and vertical lines called a histogram, which measures the distance between the two moving averages. Contrary to what many people think, the moving average lines are not moving averages of the price. They are moving averages of other moving averages. MACD's downfall is its lag because it uses so many moving averages. One way to use MACD is to wait for the fast line to cross over or cross under the slow line and enter the trade accordingly because it signals a new trend. Parabolic SAR. This indicator is made to spot trend reversals, hence the name parabolic stop and reversal, SAR. This is the easiest indicator to interpret because it only gives bullish and bearish signals. When the dots are above the candles, it is a sell signal. When the dots are below the candles, it is a buy signal. These are best used in trending markets that consist of long rallies and downturns. Another indicator is stochastic. Used to indicate overbought and oversold conditions. When the moving average lines are above 80, it means that the market is overbought and we should look to sell. When the moving average lines are below 20, it means that the market is oversold and we should look to buy. Relative Strength Index, RSI. Similar to the stochastic in that it indicates overbought and oversold conditions. When RSI is above 70, it means that the market is overbought and we should look to sell. When RSI is below 30, it means that the market is oversold and we should look to buy. RSI can also be used to confirm trend formations. If you think a trend is forming, wait for RSI to go above or below 50, depending on if you're looking at an uptrend or downtrend, before you enter a trade. Average Directional Index, ADX. The ADX calculates the potential strength of a trend. It fluctuates from 0 to 100, with readings below 20 indicating a weak trend and readings above 50 signaling a strong trend. ADX can be used as confirmation whether the pair could possibly continue in its current trend or not. ADX can also be used to determine when one should close a trade early. For instance, when ADX starts to slide below 50, it indicates that the current trend is possibly losing steam. Ichimoku Kinko. Ichimoku Kinko, IKAH, is an indicator that gauges future price momentum and determines future areas of support and resistance. Ichimoku translates to a glance, Kinko means equilibrium, while Hyo is Japanese for chart. Putting that all together, the phrase Ichimoku Kinko Hyo stands for a glance at a chart in equilibrium. If the price is above the Senko span, the top line serves as the first support level while the bottom line serves as the second support level. If the price is below the Senko span, the bottom line forms the first resistance level while the top line is the second resistance level. The Kijun-sen acts as an indicator of future price movement. If the price is higher than the blue line, it could continue to climb higher. If the price is below the blue line, it could keep dropping. The Tenkan-sen is an indicator of the market trend. If the red line is moving up or down, it indicates that the market is trending. If it moves horizontally, it signals that the market is ranging. The Chikou span is the lagging line. If the Chikou line crosses the price in the bottom-up direction, that's a buy signal. If the green line crosses the price from the top down, that's a sell signal. Each chart indicator has its imperfections. This is why forex traders combine many different indicators to screen each other. As you progress through your trading career, you will learn which indicators you like the best and can combine them in a way that fits your forex trading style. So guys, this popular chart indicators course is completed here. And with this elementary session is also finished. In next video we will start a new session middle school. So stay tuned.